Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Megan Gorman of Checkers Financial Management, and more importantly, the author of a book, All the President's Money, which tracks the investments of the 45 different U.S. presidents that we've had to date. And they are a hodgepodge bunch, as we will see. I'm going to let you talk about that. But before we do, since this is the Contrarian Investor Podcast, I felt the obvious jumping off point was to ask you point blank who the most contrarian investor is among presidents.
Well, first of all, thanks for having me on. But if you say when you say contrarian and personal finance, my mind immediately goes to Jerry Ford. Now, I'm sure you're probably like, Jerry Ford, like he was barely president. Like, why would we even focus on him? But Ford is one of those interesting characters. And when you're working with money, right, you're looking at behaviors. And what I find fascinating about Jerry Ford is every time he comes to that fork in the road that we all get to, where we're trying to make the right decision about our money and how it fits in with our life, he always takes a path that is not expected, right? So really quickly, Jerry Ford grows up with not a lot of money. He, goes to University of Michigan, and he's a football player. Now, he's also pretty lucky as a football player because the one game that the scouts go to, he has a phenomenal play, right? And he gets offers from two NFL football teams, the Detroit Lions and the Green Bay Packers. And in fact, in the Ford library, there are the offer letters offering for him to play per game. And, they're paying nothing at this point in the NFL. And, Ford's sitting there, and what today would be this golden ticket, Ford basically says, you know what? I've always wanted to go to law school. I really want to go to Yale Law. So I'm going to go to Yale and I'm going to coach football. Which is like, wait, what? Like completely the opposite of what you would do. And this is an important story just because whenever he's at these pivots, these moments where he could go the route that we all would do, that I almost would feel like is well trodden, right? And there's a little bit of security to it. He's not afraid to go in a different direction. And this is really, really important, Nate, once he leaves the presidency, because most presidents up to that point, when they left, they either wrote a book, went back to practicing law, or died, right? And Jerry Ford is like in his early 60s when he leaves the White House. And he's like, and he literally says this in some of his testimony, oral histories. He says, damn it, I'm a capitalist. I'm going to go and make money, right? And I love that about him because we're expecting the presidents to be so noble and, they're not going to get their hands dirty. But Ford's all about the money. And what's interesting is he basically brings in a Hollywood agent, a very famous Hollywood agent, Norm Brokaw, who had worked with everybody. And Ford had gotten to know Brokaw during the 1976 bicentennial celebration in the U.S. And Brokaw and him come up with this master plan on how he's going to make money. Now, he's going to do the traditional thing.
And he hired an agent to do this?
He hires an agent to help him. And remember, he doesn't really hire, because when you're a former president, people will just do things for you, right? So he doesn't have to get his hands dirty with a contract or anything. But basically, they decide, look, we're going to write a book, but it's always been the presidents before. But remember, Jerry Ford is married to one of the most fascinating first ladies, Betty Ford. And so Brokaw helps them get a book deal for the two of them. The first time a president and a first lady sign a book deal. And, Barack and Michelle should thank them for that. And Bill and Hillary should thank them for that. And George and Laura, right? And so beyond the book deal, they decide that he's going to speak and make a lot of money doing that. And more importantly, after he decides not to run for president in 1980, and they really crazy, in 1980, they actually debated having Ford and Reagan be co-presidents. The Republican National Convention had serious discussions about this. But when he doesn't run in 1980, he decides to join corporate boards. And Sandy Whale of Smith Barney talks about this. And he says, look, when you have somebody with this experience, this executive experience in running a country, having them on the board of a Fortune 500 global organization, what could be better for the organization? And if you think about it, right? If you think about boards today, you think about Apple and Microsoft and Dell. These are some of the most fascinating people out there who have incredible business experience. But Jerry Ford was the one who started that. And so I say that he's contrarian because he's sort of breaking the mold and he's doing things that at the time would have been seen very controversial. I know today in 2024, this is like child's play, but at the time it was shocking and very contrarian.
Okay. Now that's his personal life and his personal, how he got income. What do we know about his actual investments and how did those do? Yeah. And were they contrarian?
So it's funny because a lot of these guys, and Ford is a good example of this. Ford was very conservative. And why I mean that is, he did not like debt, and he was all about aggressively paying down debt and investing in instruments that were basically low volatility, right? So it sounds wild because you're expecting to open up a portfolio and seeing lots of crazy different holdings. But what you're seeing here is somebody who is really, really valuing stability. And I will tell you, what I see with people like Ford mirrors what I see with a lot of my venture capital clients, right? Which is this management of risk across the board, where they make decisions on, I'm going to focus on risk in this area, but everything else, I'm going to focus on cutting that risk and mitigating volatility. And the fact that Jerry Ford, within 2 years of leaving the White House, has no mortgage debt, I think is very telling, because I think in a way it's boring. But what I have found in navigating ultra high net worth over the years is boring is actually quite good and is something that I think is unexpected in that group of people.
Yeah. Here's how many of these people actually held public stocks, either while they were in office or after or before or both?
You know what? A lot of them have influence now, right? Now, when you look past Ford, you're looking at Carter, H.W. Bush, Clinton, Bush 2, Obama. And a lot of them are now called in to consult. Now, the Obamas are different now because they've actually gone into media, right? They have a podcast, they're producing things. They did a movie last year. But, you do see these people being more of the time brought in to speak to select groups within a company. So Ford was the one who did the most on boards, but it's not to be said that the others haven't had experience in working with corporate boards.
Was the speaker circuit a thing before Gerald Ford?
No, not at all. No. And look, we're dealing with, and you're in the investing world, one of the most fascinating elements we're dealing with investing today is this concept of longevity, right? You think about it when FDR signed Social Security into law, right? You could start taking it at 62, but they were assuming you were going to die by 64, right? So Social Security wasn't going to have this stress on it. But longevity has changed everything in terms of investing, in terms of building wealth. And so the speaking circuit became a really great way to do it. And you see that with Bill Clinton, right? Jerry Ford took it to one level. Bill Clinton took it to a completely different level. And that's because, and Hillary Clinton talks about it a lot when they were leaving the White House. When you decide to become president, you have to be prepared for your finances to take a big hit, right? Because you're paying for legal bills.
Wait, when you leave the presidency or when you become president? Oh, when you leave
become president, you often have to hire a lot of attorneys to help you, right? The presidents are fired at a lot more from a media standpoint, from a risk standpoint. And so it does often impact their finances. The other thing to keep in mind is they often today don't have a lot of excess income when they're president because the presidents must pay for their living expenses and a large part of their entertainment expenses. And they all talk about it. I mean, Michelle Obama talked to Jimmy Kimmel about this, that when they became president, she had to say, hey, Barack, don't say you're craving something, because when you do that, I'm going to get a bill in a month for a $500 peach because they had to fly it in from some crazy country. So, when you think about this, the spending part of this is really hard on their finances. So when they get out, they have to find a way to leverage to really get all of the debt wiped out, unless they came from money like a Donald Trump or a W.
Yeah, but there's so many avenues to doing that. I mean, the speaker circuit, book deals. Now you can do podcast deals. You can do all kinds of stuff nowadays. And the speaking advice, corporate boards. So it's still a pretty good position to be in.
Yeah, and Nate, I think that the challenge, right, is when you're in the investment industry, there's sort of a thesis that everything needs to be in the markets, right? But what I would tell you is what the presidents are a great example of is diversification of assets and income, right? Now, they have an opportunity set that might not always be available to us.
Yeah, I think that's a fair point.
But they're a good model of how you can think about your portfolio, right? Because all of them do have portfolios, right? And, a lot of them, because they've been in the public space, they're a little less likely to want to be buying one stock over another. What you often see is they understand something that's very key in the high net worth space, which is you really want to have a diversified portfolio because it grows money at a steady, reasonable rate of return. Investing to a large part is not supposed to be a roller coaster. Now, when we look, it's funny because when you look at the current presidential candidates and vice presidential candidates today, they show very different aspects of investing because of some of their life experiences. But a lot of them, when they leave the White House, they have their core investment portfolio. It's chugging along doing the 6 or 7%, but it's not going to be something where you're seeing crazy roller coaster rides. What they're doing is they're diversifying into different aspects, whether it's real estate. I mean, the Obamas have a really great real estate portfolio now, taking part in things like speeches, investing in things like we're seeing with the Obamas in their production company and in their podcasting. And again, you think about it, but they're trying to create different income streams by really building media empires. And that is the next shift from the Jerry Ford model.
That's so interesting.
I know from your people listening today, you're probably going, well, how do I take this and incorporate it into my finances? And I think the way you really got to look at it is, okay, I have longevity, which I never had before in the history of time. And I've got to make sure I've got a number of different things going on that will allow me to grow my wealth. I'm going to have a public portfolio. If I'm fortunate and I can meet some of the definitions, I will also have a private portfolio with venture capital, private credit, private equity, those asset classes. But then it's, what is my further diversification? Is it a real estate portfolio, right? Am I investing in certain things that can eventually help create an income stream? And that's where the modern presidents are really good examples of what you should be doing.
Cool. And a lot of them, you mentioned venture capital and private equity. Do they all also become limited partners on these funds that we know of?
From what we can tell, yes, right? We what's really fascinating with the presidents is they almost have to be naked the whole time they're serving. And then once that ends, they sort of, basically you can't find as much, right? And for the modern presidents, they tend to be very, very private. We know a little bit more about presidents like Bill Clinton, only because Hillary Clinton continued to be in the public space after he left office. So we got to see a lot of what they had. But if we carved into Hillary Clinton's portfolio from the last disclosures, you're going to see things like the S&P 500. Again, you're not seeing crazy aggressive moves, partly because they have other things they want to focus on, right? And so I hate to tell you it's not as exciting as we want it to be, but again, if I had Barack Obama or Joe Biden or Donald Trump's opportunity sets, I don't know if the public markets would be the only thing I would want in my portfolio. There's a lot out there. And that's what's important when you think about it as an investor. It's very easy to get caught up in, oh, I should just be in the markets. Being a little contrarian is exploring different ways to build wealth.
Mm-hmm. Although you have a really interesting story that starts your book about FDR taking a stake in a lobster company. Yep. And what sounds like it was a private deal. Mm-hmm. It wasn't a public company, and it went completely belly up and he lost everything. And
it does. Mm-hmm.
So these private deals are not always as lucrative as they seem.
No, and you have to remember angel investing, right? Today we do convertible notes, safes, right? This is nothing revolutionary, right? This has been going on forever. And FDR is a good example of a wealthy individual who can sort of have fun with money, right? So much of what we have to do with money has to be serious. But in his case, he was a trust fund kid, right? Now, we always think of the Roosevelt money, but, and yes, he did have trusts from the Roosevelt side, but a lot of FDR's money came from the Delano side. His mother's father had built a fortune, lost a fortune, and built a fortune in the opium trade. And so that was the money that really sort of dwarfed the Roosevelt money. But what it does is it creates what we see today a lot with high net worth investors, the ability to take an idea, think about it and think, oh, that's cool. That's great. Let me put some money into it. And where FDR makes a common mistake is that he doesn't do great due diligence, right? In the angel investing world, so much of it is relationship driven, right? I know a guy, I know a gal, they got a great idea. Let me go throw money at it, right? In FDR's case, that's what he did, but he didn't really kick the tires. And another president who did that and got burned for it in the modern day is Bill Clinton in the 70s, right? So Bill Clinton had met a guy in the 70s politically by the name of Jim McDougal. Now, we all know that whole Whitewater drama. But at the time, Jim McDougal, he had known him from the political world. McDougal had done an investment for him in the early 70s with like $2,000, and Clinton had basically doubled his money. So when Jim McDougal came to Clinton, and it's Jim McDougal and his wife Susan, and they run into Bill and Hillary at a local eatery known for its chicken fried steak in Little Rock. And they have dinner and they tell him about this great investment idea. There's this land in the Ozarks called Whitewater, and it's beautiful. If you look at pictures of what Whitewater was, you could get it. And what was interesting about it was going to be a great retirement community. And the Clintons invest in it, one, when they didn't really have the money to do it, and two, they didn't do due diligence. And the Clintons are incredibly smart people, but smart people are often afraid of looking stupid, right? They're afraid of asking the questions. And I always tell my clients, first of all, you hire me to ask the questions, right? Because I know the questions to ask. And what I always find fascinating is the first time a client goes on due diligence with me when I'm asking questions, they're quiet. The second time, they're asking the questions because what they realize is there are no bad questions. So the Clintons don't ask questions and they invest in this thing, which, by the way, if you look at Whitewater, there was no infrastructure. That should have been the first question. How are you going to move people here if you've got no infrastructure? You building a camping site, right? And of course, it spirals out of control. But this is the thing about investing. And this is the thing that most people miss. Even if you're a contrarian, you must do due diligence. The best investors are good at asking questions. And whether you like him or not, one of the best at doing due diligence is Donald Trump. Okay. So take the political aspect out of Donald Trump, right? Just think of him out as a New York guy. And if you see what he does, he's always talking and he's asking a lot of questions. He talks about a lot in his early days in the 80s. He was always working the phones, right? And I'm sure for Gen Zers today, the idea of like being in an office with all these phones ringing and your assistant, or at the time your secretary, was connecting you with everybody in town sounds crazy. But what he was doing is he was trying to gather information. And you see this with him on The Apprentice. We all see the opening of The Apprentice and he's all getting on the plane. He's the rich guy. But in the early seasons, he introduces you to his executives, Carolyn, and I'm blanking on the older guy that he had. And then in later seasons, it was his kids. They're doing the due diligence. They're asking the questions. And so that's one of the things. You can be as contrarian as you want, but don't forget to ask questions because it's incredibly important.
Yeah, but Donald Trump also had some bad investments, and the Atlantic City casinos, and I mean, I'm sure anybody could name them.
Yeah. Oh, well, by the way, that's everybody can have bad investments. That's normal, right?
100%.
It's the power of the pivot. When you have money, you can afford to mess up more than the average person, right?
Mm-hmm.
What I would tell you today, Nate, is in the past, you could mess up and pivot and succeed. Today, it's harder to do the pivot.
Mm-hmm.
I don't, by any means, say Donald Trump's a great investor. It's hard to tell. He's not transparent, right? And by the way, Trump has a different thing than most of us have to deal with. Trump is an example of someone who has to focus on generational wealth. Trump inherited from his father, by all estimates, about $400 million, right? His father's goal was not to get it to Donald and his siblings. His father's goal was to get it to his grandchildren. Donald's goal is to get it to his grandchildren. That's how generational wealth works in this country. And so when you're looking at some of this stuff, he can afford to take certain risks. And look, he's bombastic and he gets away with stuff. I'm not saying it's right, but that's how he operates.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
But I know you're looking, you want to ask me about stocks. And I think that there's a really interesting story I wanted to share about Calvin Coolidge. And we don't talk about Calvin Coolidge a lot, but he was the president. He became president when Warren Harding died.
Mm-hmm.
And Calvin Coolidge was a very thrifty guy. He actually was very much aware of conflict of interest. But if we look at the time period he was president of the Roaring 20s, right? Where the markets were just going crazy. And one of the things that strikes me about Coolidge is at the end of his presidency, he's, not going to run. He wants to go back and go back to his rental with his wife because he didn't own a home. And he gets approached by Charles Merrill of Merrill Lynch. And, as the famous story goes, Charles Merrill, was a pretty interesting character on Wall Street. And he had some interesting thoughts on what was going to happen in the markets in 1928, 1929. And he approaches Coolidge and he says, look, you're going to be a former president. Come join my board. I'm going to pay you $100,000 a year to be on my board, which is like, over $1 million today. And Coolidge is like, I don't really, I can't really opine on the markets and I don't want to undermine the next president. So Coolidge doesn't go on the Merrill Lynch board. Charles Merrill, of course, famously has his clients take their money out of the market. 1929 happens and the crash happens. And Coolidge doesn't even invest with Merrill Lynch. He invests with another big firm. And what's interesting is that other big firm comes to him in the early 1930, and they say, look, this whole crash, we're past the worst of it. It's time to deploy some cash. And he starts to put money to work in the market, right? Think about it. He's thinking probably, look, I'm being clever. I'm coming in and buying at the low. Mm. But as we all know with history, the markets don't stop falling in 1930. They don't stop plummeting to almost to 1932. And Coolidge, of course, watches his investments continue to plummet and is eventually forced to liquidate some of them because he wants to eventually buy a house. And so I think that's an interesting story because I think it's where sometimes, you've got all these contrarian ideas coming at you. You've got Charles Miller telling you the markets are going to plummet. You've got your brokerage firm telling you, okay, the markets have plummeted. It's a good time to deploy. And it's sometimes really hard to make the right financial decisions at those times.
Mm-hmm. And by the way, Calvin Coolidge did not live much. He did not live to see out the Depression. He died in 1933.
He does die really early. And, he's by all accounts a really good person. But, he isn't really good at making money. Almost there's something in him that's very much like a missionary. The historians that specialize in him use that word consistently. But I also think he struggles from a bit of financial anxiety, right? You look at a Coolidge versus a Ford. And one of the things that Ford is unafraid to do is to act. Now, he acts in a very calculated, strategic manner, whereas Coolidge almost, I think at times, struggles with taking action. And that's sort of why I think it's harder for him to make some financial decisions over the course of his life.
Yeah, he was only 60 when he died. I'm just looking at his Wikipedia page now. And
president
of the U.S. from 24 when he took over Harding in 23, sorry. And then he won his own election in 25. And then in 29 and 28, I don't know what happened.
He chose not to run
in 28.
So during his time in office, he had 2 sons. And his sons one day were playing tennis on the White House tennis court. And his one son gets a blister that gets infected and literally 2 weeks later dies of sepsis. And after his son dies, Coolidge loses a little bit of his passion for life. It's devastating. As you can imagine. And, we do have presidents, Lincoln, Pierce, who lose children in the White House, the Kennedys. It is really, really difficult for a lot of them. And so Coolidge, that's one of the reasons that factors into Coolidge's decision not to run again.
Yeah. Okay. Let's go back to the present day here. And as you may know, we have a presidential election coming up this year.
I know. And they have to disclose, although Donald Trump's disclosure is harder to read. But anyway, yes.
But he actually disclosed stuff? He didn't just say that he's not doing it?
He disclosed stuff. Yeah. It's a lot of, look, here's the deal. With Donald Trump, I'm a tax attorney. I work in high net worth, ultra high net worth. I do those crazy types of tax returns. If he actually really showed us everything, a lot of it, I think most people wouldn't be able to comprehend in the sense that there's so much sophistication and complexity. Yeah. I'm not saying he's doing everything right. What I'm saying is even if he did everything above board and was very transparent, it's very hard to follow. Okay. Yeah. And he gets access to a section of the tax code that a lot of Americans don't, which is the real estate section. So, God bless the power of depreciation because it can really lower your taxable income.
Right. And there's been some leaks about what he actually paid or didn't pay, I guess, in the 90s and et cetera, blah, blah. But, and how many of these presidents do make use of things? I imagine they all have family offices, but how many of them, do tax shelters?
Well, let's be really honest. A lot of them, when they come into the presidency or in these prominent roles, they're not wealthy, right? I mean, you go through, take Joe Biden, the sitting president. Joe Biden, over the course of his life, was never really flush with cash. And you look at things like he had a lot of whole life policies. He's constantly borrowing against whole life policies, borrowing against his house. He's very illiquid. He's a little like Thomas Jefferson in that sense. What's interesting about today's candidates is they've all made very distinct choices on how to manage their money. And some of their choices have evolved over time.
Yeah. And that brings us to, well, before we talk about the current candidates, how many of these individuals, I can say guys because they were all men so far, make use of tax shelters and things like that and shell companies and stuff? Maybe we don't know, but
yeah, I mean, you don't fully know because look, you have to remember we have some presidents who are incredibly wealthy, the Roosevelts, the Kennedys, the Bushes, right? So when you're dealing with those types of significant wealth, there's a lot of estate planning layered into it, right? So you can see there's a trust, but you might not see how that trust is operating, right? Yeah. So and you even see it when the presidents become wealthy. When you go into Hillary Clinton's disclosures, one of the things you realize is in the 90s, they set up an irrevocable life insurance trust on Bill Clinton.
Oh.
And that trust owns insurance on Bill Clinton to help pay estate taxes and to provide liquidity at his death. Right. So what I tell you is, it's not, tax shelters is such a weird word, right? Yeah. Because it implies someone's doing something wrong. A lot of times the people who have assets are taking advantage of things that they should take advantage of to help smooth the way in estate planning. Right. So I think if we were to open up, the Kennedys or the Bushes or the Trumps, and you're going to see a lot of estate planning at work. And what I would tell you is that's correct. That's what they should be doing. Yeah. And the presidents who make money should be doing the same thing as well. I mean, you did see on the Obama tax returns, they were funding 529 plans for their girls when they started to make money. And remember, Obama's didn't have a lot of money until he started to run for Senate. And his book that he published in the 90s, which he only made $40,000 on, got reissued. He made, over the course, we could see his tax returns from when he was senator to when he left the White House. He made over $16 million off of that book. Right? Okay. So he was able to build wealth off of it.
Right. Okay. All right. So present day, president candidates, and Tim Walz has attracted a lot of headlines for his investments or lack thereof.
Yes.
Because all he has is a pension, right? Does he even own his house? I don't think he does.
He doesn't. He sold his house. Yeah. Look, here's the thing about Tim Walz. We haven't had a vice presidential candidate like him since 1944 and Harry S. Truman, right? And it's part of their charm. It's also part of why Americans sort of, put their noses up at him. Tim Walz, in the scheme of wealth building, he doesn't have a lot of money, right? Let's be honest. Yeah. But I would tell you he's doing better than a lot of Americans because he's in that 20% of Americans that has pensions. So what you see with Walz's decision-making is Walz has emphasized security. And I sort of get it, right? He comes out of college, he loses his father early in life. That type of trauma will impact your finances. And he comes out of college and he's going to be a teacher and a coach. I have a lot of friends who are teachers. When you are in that industry, you're looking for the pension at the end of the day, that type of security. So I think what you see with him is someone who is focused on building security. Now, what's going to be interesting with Walz is whether they win or lose, he's going to make a lot of money going forward. Right? Yeah. He's got the golden ticket. So you see someone who really he's made choices about building stability, about having income streams, predictable income. And remember, teachers often don't get Social Security. So he's got these pensions. He's got his governor's pension, but he doesn't own a house. There's been some guesses that maybe he has a 403B and we just don't see it, or that there's a 403B, but they also released information that he borrowed against it to pay for his kids' education. So again, not a sophisticated investor, and in a lot of ways, like a lot of Americans. Now, what's interesting is on the other side is JD Vance, right? I don't know if you've looked at JD Vance's his stuff. So JD Vance, as we know, is probably one of our poorest candidates from birth, but is someone who has climbed the American socioeconomic ladder very, very quickly. Okay. And he did it through a very Reagan-esque technique, right? He used education and getting access to higher education, and then using connections to propel him forward. So if he hadn't joined, the National Guard, I believe it was, and then went to Ohio State, he never would have gotten to Yale Law. And once you get into these certain types of educational institutes, you get access to a better opportunity set. Right. I think the Wall Street Journal just released their top schools for, making money. And basically, if you go to MIT or Babson, you got a good shot of making good income. Right. They've been studying this. They've studied graduates years out. So Vance is interesting because at law school, he befriends a Professor Amy Chua, the Tiger Mom, and she gets him connected in that whole world of, becoming, venture capital and writing his book. And meeting his wife. And Vance does something that a lot of presidents have done over the period of time. He marries up. He marries a wealthier woman who is also successful in her own right. So when you look at his portfolio, he has a bunch of diversified income streams. He still has royalties from the book. And this year is going to be an awesome year from him income-wise because they've had to reissue the book. It's back on the New York Times bestseller list. They're making a lot of money off of Hillbilly Elegy. And they sold the rights to the movies and so on. But what you see in his portfolio is something that you see with a lot of venture capitalists. You see vintages of the funds that he's a GP on. And the truth is, a lot of these funds are very early in the life cycle, very early in the J curve. So we don't know if they're actually going to turn into anything. Now, what's surprising to me with Vance is usually with venture capitalists, they have big venture portfolios and then they invest in their friends' funds. And then you see big municipal portfolios, big municipal bonds, right, to cut the risk. In his case, we're not seeing that. We're seeing a lot of like crypto. We're seeing, I think he had a very large Walmart position. You're seeing him sort of doing this sort of, I want to say almost millennial type investing, where he's like sort of going by whim into these things. And so he takes on sort of a lot of weird risk in his portfolio. partly because, he's got a wife who up until the campaign has been driving a significant income stream. He's a senator, and as you know, the senators are building a pension, and he's got this great royalty stream. So he's a little bit of, okay, I can take on more risk because I've got some other things that I think will pay off.
Mm-hmm. What about Kamala Harris?
Kamala, right? So Kamala is interesting. If you look at the evolution of her portfolio, early in her career, she worked for the city of San Francisco, the state of California. I will tell you, as someone who lives in California, they have a pretty robust pension system. So you see her pensions there, but then you see her investing. And her, Kamala and her husband, Doug Emhoff, have built a substantial portfolio. But one of the things that they have focused on is being very conflict free. And so if you look at the evolution of her disclosures from like 2016 to today, you see her go more and more into ETFs and very diversified, right? She's got the standard ETF asset classes, large cap, small cap, emerging markets, international. If I had to critique her portfolio, I would say, look, Kamala, with this size of assets, I probably wouldn't be doing bonds through a mutual fund. I probably would have a separately managed account for my bond portfolio and owning municipals or treasuries. But you're seeing, again, very conflict free. And when she became vice president, her husband divested himself of all of his partnerships. He was a partner in a very large law firm in LA. By all accounts, they loved him. He basically got out of the partnership, and he's a professor over at Georgetown. So very conflict free. It's sort of boring. And as I've said, the best type of investing can be boring. So how I look at it is most people are not even doing as well as Tim Walz, right? With that stability factor. Most people look at somebody like a JD Vance and think, oh, that's sexy. That's exciting. I wish I could do that. But they don't have those opportunity sets. And when they look at Kamala, they probably are like, what is she doing? But the truth is they should aspire to have a portfolio like Kamala because it's diversified. It can weather different marketplaces. It's not trying to outthink the market, and it's not trying to get into, that sort of big bet type of move.
Mm-hmm. Yeah. Interesting. You mentioned in your book that, the presidents, not all of them were rich or even middle class.
Right.
Barack Obama, Bill Clinton, in recent memory, certainly grew up not rich. And then Abraham Lincoln and others as well, in the more distant past.
Mm-hmm.
Did any of them, and some of them, we mentioned Coolidge, who kind of didn't die rich. And then you also have Ulysses Grant, who was at one point, I think, broke after leaving the presidency.
Many times broke. Many times. He is the unluckiest guy, but he's also too trusting. Love Grant, amazing Civil War general, right? You read the stories about him, you can't be helped to be drawn to him. But the trust that made him believe in his generals, right? Or the guys who were reporting into him. And he was also a great horseman. They called him a horse whisperer. That sense of trust that he could have also undid him financially. He often was too trusting. And so at the end of his life, he was part of a brokerage firm that the partner got him in a Ponzi scheme, and he loses all of his money. And he, starts to write some articles about what he did during the war, and he realizes he's actually a good writer. And Mark Twain comes to his rescue and helps him negotiate a book deal. And Grant at this point is dying of cancer. There's a famous picture of him wrapped up in a blanket. I mean, he's literally dying and writing. And I believe literally days after he finishes his memoirs, he dies. But he makes enough money from these memoirs for his family to live very comfortably for the rest of their lives. So, he was also, over the course of his life, trying to invest in these great get-rich-quick schemes, right? He wanted to move ice from Vancouver to San Francisco, and he didn't realize that the ice, if it got delayed, would melt before it got to San Francisco in 1850. He was making these really great ideas, but he was not good at execution. And so it undoes him. But, I want to mention one president who's really amazing with money, and I want to put one caveat because he was a slaveholder. So you have to do the lens through that. That's
true. And I think you said a quarter of them were slaveholders.
12 of them. Yeah. And but George Washington is sort of amazing with money. You think of him as so stoic and boring, right? We think of the famous portraits of him or him on his money, but he was a total like financial hustler because he didn't have money he had money growing up because his father was wealthy, but when his father dies, his brother inherits everything, and they don't even leave money for George to go to college.
Wow.
And so George has to teach himself to be a surveyor. And he's very good looking. I mean, everybody's like 5'6" in 1740. George is 6'2" and he's sexy, right?
Oh.
And he uses that and his connections to get better surveying jobs. He starts to buy land. By the time he dies, he owns 52,000 acres around the country, from New York to Ohio to Virginia to Kentucky. And he does something like a lot of other presidents will eventually do. He marries a wealthier person than him. But what's interesting about Washington is he does have stock. And Washington does things at the end of his life where he donates stock in his estate plan that eventually, like, to schools, and they eventually rename themselves. And, there's a school, I'm blanking on it, but it's every time somebody goes there, it's a private high school, some of the initial seed money from George Washington's stock donation is technically still paying for people's educations.
Wow.
So, those types of techniques were always around. Everybody thinks all this stuff is new today. Donor advised funds are new. They're not. They've always been around, and people took advantage of them. And Washington was a very sophisticated investor, but his investments were predominantly land.
Yeah.
And you could make the argument he was our wealthiest president.
No kidding.
Mm-hmm. In fact, when he died, his asset base, he thought he was worth about 530,000. At his death, they valued it at 780,000. But you have to remember his net worth at his death was basically 20% of 1% of the US GDP at the time.
Wow.
Right? So you start to, it's hard just to compare them in this sense, but it's a lot of money, right? I mean, people say, was Donald Trump the wealthiest? His net worth is not even a fraction of the US GDP today, which is in the trillions.
Wow. Okay. You mentioned slaveholding and the fact that FDR's wife's family made their money on opium.
Mother's family.
Sorry. Yeah. That's crazy. Are there any other nefarious things that these people made money on?
Yeah, I mean, look, here's the thing, and I go into it in the book. First of all, slave owning, slave trading, just morally reprehensible. But when you study the presidents, right, and presidential people love James Polk because he's the one who expanded the United States, right, Manifest Destiny and all that fun stuff. But James Polk, when he was in the White House, was engaged in straight slave trading, right? And there would be a spread, right? Like he would buy families where there was children, and then he would wait till the children were older, and then he'd resell them because the younger the slave, the more valuable they were. And then, of course, he brings Texas into the Union, and there's the whole debate of, is it a slave state? And of course, he's selling slaves during this time period and profiting off of it, which is horrific. And he's doing it secretively. He has agents doing it for him. So he's building his wealth, but his wealth was built in just a morally just corrupt, horrible way. And so you look at that and you're like, oh gosh, and he was trying to hide it. And the only reason we know that happened is he leaves the presidency and he dies within a year. He dies of like chronic diarrhea or something like that. And he doesn't have a chance to really impact his papers. And so there's still letters that exist between him and his agent on slave trading.
Wow. What about insider trading? Do we know how many of these people did that?
You know what? So insider trading is an interesting thing, right? So let me talk to you about W. George W. Bush, interesting guy. When the Bush family has a mantra, which is, yes, we have money, but basically you have to set off to create your own legacy. And so his father, H.W., comes back from the war, could have went to Wall Street like his father was at, but instead he goes to a small town in Texas called Odessa and gets into oil in the 1940s and 50s, which now in retrospect, you're like, of course. But at the time, people were like, are you crazy? And they didn't have a lot of money, him, Barbara, but they eventually make a ton of money in oil. And W when he's coming out in the 70s after college, he decides he's going to go into oil as well. And he sets up a company called Arbusto, which is Spanish for little bush. So he's got that little charming personality. And over time, he does just okay. And he ends up selling his company. And then that company gets sold to another company. And in the early 90s, when his dad's fighting the war in the Gulf, W is on the board of a publicly traded company. And by all accounts, he's a decent board member, right? He's got a charisma, he understands business, and he decides he wants to sell some stock. He gets approached to sell some of his stock, and he goes to the general counsel of the company. And he's like, "Hey, I want to sell this stock." And the general counsel goes out and gets an opinion from an outside law firm. And they say, look, it's okay for him to sell the stock, even though he's on the audit and financial committees and is seeing some of the challenges we're having. And W sells the stock for a profit, and he eventually gets accused of insider trading. And the reason he gets accused of it is the company bobbles his filings, right? When you are an insider and you make a trade, there are some reporting requirements that you must make to the SEC to publicly announce the trade. And they don't file it on time. It's a bit of a mess. And he does get accused of insider trading. And the SEC does this whole review, and he ultimately is determined not to have done insider trading because he followed all of the process, right? He went to the general counsel, they looked into it, they hired an outside firm, they did their diligence. They were just sloppy. And so, I think in that case, what I would tell you is when you are prominent, when you are on these boards, you have to think of this question that I ask my clients all the time, which is, if this transaction appears on the front page of the Wall Street Journal, what does it look like? And nobody asked W that question. So for the amount of profit he made, it probably wasn't worth the headache.
Yeah, that's crazy. Wow. But there's no other that we know of, no other examples of anybody doing anything like that or...
Look, what I would tell you today is in the early parts where politicians were sharing their asset base, they also knew it was the right thing to not act on that. So I'll give you an example. We are coming upon, I believe it must be the 72nd anniversary since 1952. Am I doing my math right? Of Richard Nixon's Checkers speech. Now, Richard Nixon's Checkers speech is Checkers is the name of his dog. He's been accused of mishandling $18,000 of financial funds. Eisenhower's about to dump him off the ticket. Ike is very strict. And Nixon gets a television spot. And in this television spot, he's explaining, I didn't misuse this $18,000. Let me tell you my asset base. And he proceeds on national television to read off his net worth. Because to him, it's so important that people see that he's not conflicted.
He's not a crook.
Right. He is not a crook, right? It's funny how everything comes full circle. And what you see over time, and in particular the last 20 years, the erosion of the feeling that you need to do the right thing. And so one of the things I would say is, I really think it's probably not right for politicians to own single stocks.
Yeah.
At the end of the day, ETFs are fabulous. Okay. They get the job done, right? And they're actually more tax efficient at time. So I think the problem you see with the finances today is that they aren't doing diversified portfolios that are just ETF driven. And if they really want to play in a sector, there's sector stuff. So take a look at Kamala's portfolio. I think she's done a very good job, whether you like her or not. And again, I'm not being political here, of trying to be conflict free and show you what a politician's portfolio should really be, because they really shouldn't benefit. And I should mention, when you go through the records of people like Ford and Carter and Reagan and HW, you do see the blind trusts that are managing their money while they are presidents.
Yeah, sure. Right. Megan Gorman, thank you so much for joining the Contrarian Investor podcast today. Very interesting conversation. In closing, maybe tell our listeners how they can find out more about you, how they can get their hands on this book.
Yeah.
And other than dropping it in the search in Amazon, I guess. But let us know.
Yeah. Find the book at allthepresidentsmoney.com or at Barnes & Noble, Books A Million, or Amazon. And you can find out more about me and my firm at Checkers Financial Management. And that's Checkers with a QU, not like the Nixon speech. And it's a high net worth firm based in San Francisco that's focused on tax and financial planning.
Very cool.
Nate, thanks for having me on. Oh, I'm sorry.
Yeah, thanks for coming on. It was really great to have you. And with that, thank you all for listening. And we will look forward to speaking to you again in a couple of weeks. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.